afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the first installment of the Option Industries Council's webinar series for 2015. My name is Nick Ziegler, a staff member here at the OIC, and I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's session, we'll take an in-depth look at the OIC website, which has a wealth of tools at www.optionseducation.org that can help with your market research, and we'll go through it all in a quick 60-minute session. Our instructor today is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of options and investments to the table. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you're able to submit questions at any point during the presentation. Joe will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. For your convenience, you can access a PDF version of today's content via a download link that's just below your slide window. And if you'd like to review the entire webinar, an on-demand version will be available a few hours from now via the same link you used to join us today. Additionally, our previous webinars can be viewed on the OIC YouTube channel. And now, ladies and gentlemen, Joe Burgoyne will bring you our topic today, Enhancing Returns with Option Trading Tools. Joe?
Nick, thanks a lot, and thanks to everybody for joining us today. Hard to believe that we are, it's probably been a little over 5 weeks since we were together last. So again, thanks for joining us. And as Nick said, tonight's presentation is about the option trading tools and resources that are offered on the OIC website, which, as Nick said, is optionseducation.org. Before we get started, I think it's important that everybody knows that the industry does put out a document called Characteristics and Risks of Standardized Options. A lot of good information in there. Be sure to either get a copy from your broker or from the OCC. Many of you, I'm guessing, have joined us before, but typically we get about 35 to 40% of new attendees for each of our webinars. So for the new folks out there, just so you know who the OIC is, we are an industry cooperative funded by the members of the OCC, that's the Options Clearing Corporation, and the 12 U.S. option exchanges, which are posted here. We've got an updated industry volume slide for you through 2014, and 2014 turns out to be the second busiest year in the options industry, which dates back to 1973. We did over 4 billion contracts for the 4th consecutive year. As I said, the second busiest year in history. And on average, we did just below 17 million contracts a day. I think it was 16,900,000 and some odd thousand. So, you know, a very active year again in the options industry, and that's really with the backdrop of a market up until maybe the last couple months that really had some relatively low volatility, and I think it speaks to how many more people, both retail investors and institutions and financial advisors, are looking to the listed options product to enhance returns, manage risk, and generate income. So tonight, you know, we are going to take a look at the website in some depth. We'll look at the different drop-down bars that give us a lot of the different areas of resources and tools that are offered, strategies and concepts, our OEP, the Options Education Program, how we post our seminars and events, the all-important tools and resources area, news and research. And then actually on the site, we often get a number of advisors who tune in for the webinars, and we have a section for advisors also on our website. So there's our homepage, and that's a picture of our friend Bill Ryan from the New York Stock Exchange. He is one of the OIC instructors. Those of you who attend the OIC live events will do, on average, about 25 cities a year, maybe a little bit larger number than that. Bill will get out to a lot of the cities, as do folks like myself and others as well. But that's our friend Bill Ryan, who's featured on the homepage at this point. We have, as you can see, the drop-down bar. We have 7 different sections on the website. We've got Getting Started. We've got Strategies and Advanced Concepts. We've got this particular slide I've actually dropped in here because I don't want us to lose sight of the fact the reason we're talking about trading tools, enhancing returns, it's always critically important to remember, what is the risk of my position? And for those of you who have joined before, from time to time I'll offer this slide because I think it's a very comprehensive slide. Those blue lines represent the risk and potential reward in positions. 18 different strategies here. And the thing about options, as I said earlier, they are good for position management, risk management, also income generation. Some folks use options to speculate as well, but by and large, these are dynamite financial tools that allow us to manage risk and generate income. I'm going to just, quickly go through these different 18 strategies. So again, remembering that, we use tools in order to obviously improve returns, but always keep in mind what's the risk. How much am I putting up and what's my potential reward? Top right, long call. You buy a call, you're looking for the underlying to go up. If volatility goes up at the same time, you're going to make money both on the direction of the underlying, if your forecast was correct, and an increase in the premium involved. The premium increases when implied volatility goes up. So the long call, limited downside risk. Okay, you can lose the debit you pay for that call. Unlimited profit potential to the upside. Now the next little graph there is the short call, and you can see how the blue line goes down hard to the bottom right hand quadrant. In a short call, the maximum profit you could make is the premium you take in for that call. If you sell it for $2, you can make up to $2. You sell it for $10, you can make up to $10. But notice, the key here, short call, the position by itself has unlimited risk, and you always have to be cognizant of that. The long put, just like the long call, has limited downside risk. You can lose, the amount you pay for the put. Your profit potential is significant because the stock potentially or index could go to zero. So it's not unlimited profit potential, but is certainly significant. The short put, on the other hand, just like the short call, doesn't have unlimited risk, but that bottom left-hand quadrant, you can see if a stock were to head south in a big way, that short put is going to gain value. In this bull market that's been going on for well over 5 years at this point, short puts have been a very successful tool or strategy, I guess is the better word, for investors. The rising tide oftentimes floats all boats, and a lot of stocks have gone up with this bull market. So selling the put has been a cash-generating vehicle that has worked for a lot of investors. But don't forget, the downside risk, as the little graph there suggests, is significant. Long straddle is where you are long the call and the put at the same strike, and so you've got unlimited profit potential to the upside, significant potential to the downside, but your risk potential is if that stock doesn't move around or if implied volatility goes down, you're long both the call and the put. So you're going to lose that premium, or at least a portion of that premium. That's the long straddle, looking for a big move up or down. Short straddle is just the opposite. You've sold the call and the put at that same strike, same expiration. So you're looking for the stock to just stagnate and not do much and collect that premium. But know full well, again, talking risk versus reward. We sell that straddle for 5, 6, 7, 8, 9, 10. That's the most we can make. If the stock takes off to the upside or gets hammered to the downside, that straddle could explode, and you've got, to the upside, unlimited loss potential. To the downside, the difference between the strike price less the credit you took in to zero would be your downside. But significant risk potential with the short straddle. The difference between a straddle and the strangle is with the straddle, as I said, you're long the call and put at the same strike. With the strangle, the reason your break-even line goes horizontal for a longer period is because you're long an out-of-the-money call and an out-of-the-money put. So in between, at expiration, as the chart suggests, you're going to be a loser. But if the stock moves big to the upside or downside, just like the straddle, you're going to be rewarded handsomely. The short strangle, just like the short straddle, is short that out-of-the-money call and out-of-the-money put with very significant risk. The long call spread is just that, buying one call, selling another. In this example, as the underlying goes up, you would make money. As the underlying goes down, you would lose money. Just like the long call or the long put, the long call spread, you can lose the debit you pay for that spread. That's it. And the maximum profit is the difference between those strike prices minus the debit paid for that long call spread. So that's what the graph represents there. The long put spread is the same psychology. Long one put, short another, same expiration month. Basically, long vertical spreads is the terminology of the call spread or the put spread. You can lose the debit you pay for. The maximum value is the difference between the strikes minus the debit you pay for that put spread. Difference being a long put spread, you're going to be looking for the underlying. Your forecast is bearish on the underlying. A short call spread, okay, unlike a short call or a short put, you've got, as the graph suggests, limited loss potential, okay, limited reward, limited risk. And that's why I'm going through each of these. Again, the tools that we offer on the site can help you fine-tune what your maximum loss, maximum gain may be. And that's why I just want to really hammer home this whole idea that the reason we use the tools is, to get this clear understanding of our risk reward. Again, the short call spread, we can make whatever credit we take in for selling that spread. The most we could lose would be the difference between the strikes minus the credit we take in for that spread. The short put spread, same psychology or same rationale to risk reward, but when you're short a put spread, you are looking for the underlying to go up, whereas with a short call spread, you're looking for the underlying to go down. I'll go through just a couple more there on the last line. That ratio call spread, look at the way on the left-hand side, you can see your break-even goes horizontal. You've got a maximum profit above the break-even line, assuming you did this thing for a credit. But the fact you can see in the bottom right-hand quadrant, that blue line is just heading south. And what that's telling us is that this is a ratio call spread where we are short more calls than we're long. So at some point, those short calls, can, do a lot of damage from a risk-reward standpoint. If your forecast on the underlying turns out to be incorrect and that stock takes off, you've got significant upside loss potential, because in the ratio call spread, you are net short calls. And that's just like being, naked short calls, and there's a lot of risk there. Same thing with the ratio put spread. You can see the difference. The downside is where the risk is here, because we're net short puts. And if the stock were to tank, those net short puts would come back to hurt us in a big way. The call volatility and the put volatility spreads, you can see on the call side, you make money to the upside. On the put side, you make money to the downside. That's where, we're net long calls or net long puts. And as the stock goes in the direction that we forecast, we're going to make some pretty good money. The long split strike synthetic I'm not going to get into, and the collar is basically, that's a three-part position. The collar has a long underlying component, short an upside call, and long a downside put. So the short call caps our profits to the upside, and the long put caps our losses to the downside. Oftentimes, investors try to do these for close to even money, but again, it depends on the skew in the marketplace. It depends on a lot of different factors, but the key here is that limited risk, both to the downside and limited reward to the upside. That would be the collar. So again, I'm going through these just because as we talk about the tools, always keep in mind that the strategies themselves are key, as is their risk-reward ratio. And we have lots and lots of different strategies out there. So you always want to be aware of the risk-reward. Another drop-down section is our OEP, the Options Education Program, which has a number of different features. We've got the seminar and events drop-down, as well as the to me, well, they're all important, these drop-downs, because there are lots of tools and resources. But under tools and resources, we're going to get into a lot of things tonight because there just happens to be an awful lot there. We've got the news and resources drop-down. And as I mentioned earlier, we've got that last one, options for advisors. There's some things. I know that we do get a number of advisors tuning in for the webinar, so don't be afraid to check out the resources there. There are lots of goodies. So going back to our first drop down, getting started. I guess, one thing I'd like to focus on, we have a section for benefits and risks. And for those of you, getting started, this is really a crystal clear layout on what's an option. There are three very easy to read parts, and I would urge you, if you're getting started, go to the Getting Started drop down, hit benefits of risks, and spend 30 minutes going through this, but spend those 30 minutes maybe 3 or 4 times over the course of a couple weeks to let it sink in. Also under Getting Started, one area I'd like to feature is just the option pricing area. This gets a little bit more involved. Here we talk about some of the key pricing concepts. There are 5 pricing factors, which are straightforward. They're laid out. Different concepts like intrinsic value and time value are also laid out. Option prices are composed always of time value. assuming there's some value to the option, and maybe intrinsic value. Intrinsic value would be the in-the-money amount. So there are lots and lots of options that don't have an in-the-money amount. Let's, just as a quick example, if we have a $50 stock and we're looking at the 55 calls, so the underlying is trading at 50. The 55 call is the option to buy stock at 55. Since the stock price of the option is above the price in the marketplace, that option is considered out of the money. And if it's out of the money, it has no intrinsic value. Again, that $50 stock, if we were talking about a $50 call, it would be right at the money. So again, no intrinsic value. Now, if we were talking about a $45 call, that would be an option where you have the right to buy the underlying at $45 with the stock at 50. That option would be $5 in the money, or that strike would be $5 in the money. So you'd have intrinsic value of $5 plus whatever the value of the time in addition to the price of $5 in the option. So if the option were valued at $5.50, you'd have $5 of intrinsic value and 50 cents of time value. If it were valued at $7, it would be $5 of intrinsic value and $2 of time value. So, you know, in the option pricing section, we get into different concepts like that. The next drop down, strategies and advanced concepts. All kinds of goodies here too. You know, under strategies, you know, there's just some great opportunities here. We basically give you a chance to pick a bullish, bearish, neutral, or sharp move forecast in your underlying. And then on top of that, we have different objectives. You know, are you putting on the strategy so you can acquire stock, so you can sell stock, things like that. Additionally, for those who, you know, might be a little more involved and advanced, we give you an opportunity to have an opinion on volatility, the all-important implied volatility, which, again, for those of you getting started, implied volatility is the market's forecast for amount of movement in the underlying going forward. And so if you think, you know, the amount of movement in that underlying is going to increase, you know, in the future, you have a bullish opinion on the implied volatility. That implied volatility would increase as the underlying begins to move more and more. So, you know, on the advanced concept page, we give you an opportunity to have an opinion either bullish or bearish on implied vol. And with that, we offer, you know, different strategies for you to research. So that's our strategy and advanced concepts drop down. Really wonderful, wonderful things in there. Just take some time, hopefully getting comfortable with it. And, you know, here's just a snapshot of the advanced concept area. In addition to the strategy area, here we get into things that are more advanced, things like understanding Greeks, put-call parity, which is a wonderfully important concept, which, like so many things in the option space, you know, many, I'm going to say investors, but not just investors, you know, people who are actually in finance sometimes think that, you know, options are very complicated. They are confusing oftentimes in the beginning. You have to be very, very patient, giving yourself an opportunity to grasp the concepts. But frankly, they're not that complicated, you know, unless you get into writing the math models and all that jazz. You know, sure, that's very complicated material. But the concepts themselves really are oftentimes very straightforward. You just have to go over them a number of times over some number of months. Typically, this stuff doesn't just come to people. I mentioned the whole idea of put-call parity. What that represents is the relationship between the underlying, and remember, option prices are always driven by the value of the underlying. That's critical for those of you just getting started. As the price of that underlying changes, the value of your calls and puts are going to change too. And this whole idea of put-call parity is the relationship, and there is a constant relationship in the market between the underlying, whether that's a stock, an index, or an ETF. It's the relationship between the underlying, the price of the put, and the price of the call. The calls don't trade out there by themselves, and the puts aren't out there by themselves. Those three instruments, the underlying, the put, and the call, have a constant relationship and value in the marketplace. And before the business got so automated, those relationships would oftentimes, I don't know about often, but far more frequently get out of that fair value alignment. Now, with so many things being computerized, those and basically these relationships in put-call parity are relationships called conversions and reversals, and it's very rare in this highly technical market that those relationships get out of whack. But just to know, there is a direct relationship between the price of the underlying, the price of the put, and the price of the call at all times in the marketplace. So you can get into that under the Strategies and Advanced Concepts drop down and check it out under Advanced Concepts. Now the OEP, which is the Options Education Program, we got a couple dynamite goodies here. And the one that I talk to investors about all the time is our MyPath assessment. And that is a 20-question test, if you will. And the page that I have up, basically you have to log in, to the website when you're doing the MyPath assessment. So you'll have to give your contact information, things like that. But then you get a 20-question assessment, and depending on whether you're new or advanced, you'll either bomb the 20 questions or you'll do great. And it doesn't matter whether you bomb them or do great. The key is that we're going to find out what level you are in terms of your option knowledge. And depending on the results of the 20-question assessment, we will then download lessons for you at the appropriate level that you can, obviously go and do anytime you wish. And as you complete one section, I guess there's a beginner, intermediate, and advanced level. We have courses in each of those areas. Once you complete one area, you move on to the next. So that's the all-important MyPath. Also, under Options Education Program drop-down, we've got the course catalog. It includes, I don't know how many hundreds of different videos, webinars, podcasts, although podcast is next, I think, in its own separate area as well. But all kinds of things to basically go in and investigate in the course catalog. And as I mentioned, the podcast section, we've I think got well over 100 podcasts. Part of that program is called Options Talk with OIC, where I had the opportunity to interview many experts in the industry, and we get into conversations typically that last between 11 and 16 minutes on different option strategies. So that's Options Talk with OIC, and you can find them under the podcasts. The next drop down is the straightforward seminar and events drop down. As I mentioned earlier, we'll do somewhere in the neighborhood of 25 to 30 cities across the U.S. in 2015. We'll have our retail seminar program, which some cities we come to 3 times with our 3-part series, basically one generally 3-hour seminar for 3 consecutive weeks. And we have posted our spring schedule on the site, so please check that out. If you haven't been to any of our live seminars before, I would urge you to try to make the effort. We do our best to, pick cities where there's a lot of interest in OIC, and we're cognizant of trying to find a good geographical area. We try to get the hotels to give coupons for parking, at least reduce parking. Sometimes the parking's free. And the wonderful thing about the live seminars, from my perspective, I happen to actually give a number of them myself, is the fact that you're in a group, and on average, I think we average about 100 attendees at most of our seminars. I think it should be more, but that's about what we've been averaging. And I think that you're in a room with like-minded people, so you have an opportunity to maybe meet some folks who may be right at your level of options knowledge. You may have an opportunity to meet others who maybe know a little bit more or less. And oftentimes there are groups in the cities we go to that have their own investment groups where they meet once a month, and it's an opportunity to meet folks like that. And if you're into it, start to go out and meet maybe once a month or once every couple months with like-minded folks with regards to investments. So and then the other thing about a live event is you get the perspective of somebody presenting who's been in the industry for a long time, and you get a chance to talk to them and get their perspective over the course of about the 3 hours. So straightforward seminar and events page. We post other things like the webinar program here as well, which Nick does a very fine job getting the information out to folks on that. I mentioned earlier the all-important tools and resources bar. All kinds of goodies here. We've got one of the pages, or one of the sections is just investor resources, all kinds of goodies you can check out there. If you didn't know it, we do offer option quotes, on our homepage, and so you can get option quotes in detail. Of course, any series as far out as you want to go with, all the Greeks. We've got, the chains, and as I say, you've got all the Greeks, as well as the various implied volatility levels, and with on the website, I guess on the home page, we've got our search bar top right-hand corner. If you want to find any of some of the option chains and volatilities, that's another way to access it as well. But dynamite tool there. This area under tools and resources happens to be my very favorite, and that's because it's a section that is titled Historical and Implied Volatility. And so you go to the tools and resources bar, and you'll see, I think we've got maybe 17 different drop downs under tools and resources. But midway down the left-hand column, this historic and implied volatility to me is critically important if you are going to get pretty serious about having a sense for options and where their value is derived from, and whether you expect the level of premiums or the implied vols to go up or go down in the future. So again, it's midway down the left-hand side, historical and implied vol. Now you can see on this particular snapshot that kind of middle right, we've got those three thumbnail charts. And to me, they're very, very important. And the one in the middle is by far the most important. So if you go to that first page that I just had up, historic and implied vol, and then you double click any one of those small thumbnail charts, this is what'll come up. So the chart on the top is your price chart over the course of the last year. And of course, that's pretty important. But it's this next chart that, to me, this is the big enchilada. This is the implied vols versus, historic vol. And historic vol is the amount of movement, and I call it basically the personality of a stock. Does it move a lot? Does it move a little? You know, historic vol is how much the underlying has moved in the past. If it moves a lot, and we're not talking about a direction necessarily up or down, but just if it moves around a lot, because of that, the option premiums are going to be far greater than a flatliner stock that doesn't move around. That's how the option space works. So, you know, if you hit that middle thumbnail chart, you'll get this pop-up, which, you know, the blue line is the 30-day historic vol, which, again, back in the detailed options change, you can get it there too. I like to look at this thing graphically because, you know, that just is a lot more comfortable for me. But the all-important second line, you know, that green line, is the implied volatility and what it has done. And again, just like the underlying price chart, this is over the course of the last year. So you can see the relationship between the historic vol versus the implied vol. It's not a constant relationship on the vast majority of underlyings. Okay, the relationship between historic and implied typically vacillates up and down. The marketplace usually prices implied volatility slightly above historic. That's typically how the market prices things, but not always. And, you know, just from a common sense point of view, you think about the market doesn't like uncertainty in either the market itself or a particular underlying. So as we get to earnings in some companies, especially companies where the earnings may be all over the board and surprise Wall Street, if they have listed options, those option premiums, you know, expand dramatically going into that announcement because of the uncertainty. And what happens there typically is the implied becomes, you know, the difference between the historic and implied typically widens rather dramatically in advance of earnings, but not always. But the nice thing is, and I'm not sure the philosophy of those of you on the phone tonight, I personally like to, you know, not get too crazy looking at too many different stocks. Try to concentrate on a sector that I like, or not a sector, but a few sectors, and then, you know, my favorite stocks in those sectors, and then, you know, get a feel for how the implieds tend to trend versus historic over the course of a year, and watch that. And that's why, to me, you know, this drop-down historic and implied volatility tool is just so meaningful and so useful, and you know, hopefully a great tool that will allow you to enhance your returns going forward. So you've got the stock chart, you've got, you know, which is the top thumbnail. You've got the middle one, which is the historic versus implied, and then the last much smaller thumbnail chart is just option volume itself. And I don't particularly pay a whole lot of attention to that chart. I mean, I'll look at it and look for, you know, is there any consistency with spike in volume? You know, do you get a spike in volume at expiration? You get a spike in volume at earnings? But, you know, more typically, when I look at option volume, I'm more interested in looking at the average daily volume over a period of time, and then I look for a spike. And, you know, when I see a spike, then I like to go in and investigate, you know, the movement in the stock, the movement in the underlying, because chances are you get a spike in options volume. Somebody not necessarily knows something, but somebody is maybe thinks that they know something about the future direction of the underlying. So, you know, that was the historic and implied vol area. We've got another tool which can be very, very useful, our virtual trading system. Here you get the opportunity to, you know, basically try to build on the play money that you're offered when you open the trading system. You know, you'll start with a lump sum, put in your trades and have at it. And that's the virtual trading system, which can be a great, it's basically it's an if account. It's a trading tool. It's an opportunity to track your ideas without your hard-earned money on the line. And that's the virtual trading system, which again you'll find under the tools and resources drop-down bar. Back to my focus on risk versus reward. The position simulator, which is here on the site for you 24/7, is a great way to go in and look at the risk versus the reward in any strategy that you come up with. It can be a combination of long or short the underlying. It can be a combination of lots of different options. You can change the days to expiration. You can change the implied volatility. All kinds of different market scenarios can be tested in advance of putting on a position. Your particular simulation may not duplicate the market itself, but I was when I was down on the floor for all those years, big believer in, just give me a pretty good idea. I didn't need to know things to the penny, but if the stock went up $4 or down $4, what could I expect my options to do? So I was maybe a little bit more of a generalist, but knowing full well, am I long vol, am I short vol, what's my gamma, what's my vega, what's my theta, just basically managing the Greeks in an overall sense, maybe not in a microscopic one. So the position simulator will give you a very good expectation for where you think your position will go given particular moves in the market, but it may not duplicate exactly the different simulations that you put in, or versus the market itself. Another basically resource here is if you're interested in the most actives, and I think that depending on how much time you have during the day, I think it's always interesting to go in and see what the most active different equity, index, or ETF options are. And that's basically the little red boxes highlighting if you hit each of those different boxes, you'll get the most active equity or index or ETF options. So I would urge you, it's interesting to see, if the same names are coming up over and over, whether you have new names. Again, when option volume, I always like to work off of a baseline of what is the average daily volume. I used to do it over basically a 1 month period, so there are 20 or 21 days in the trading month. So, I'd want to know what that average daily volume, option volume was over those 20 or 21 days, and then look to see, a 2 or 3 time multiple of that option volume to see, unusual unusual activity, which they may lead to, some idea of the underlying moving fairly large one way or the other. Next resource, as I said, there are a lot of goodies under tools and resources. We have our options calculators, and we've got basic calculator, we've got an advanced calculator, and then we've got a cycles calculator. And basically, the cycles calculator just tells you what cycle the options are in. So I mean that's pretty straightforward. You can find that under your options chain. But the options calculator, the basic one and the advanced one do pretty much the same thing, but I like the advanced calculator better because everything's right there in front of you. If you go into the basic calculator, you have to put input in each screen at a time, whereas you can see on the advanced calculator, you've got all those different boxes that are right there in front of you. You can plug in what you need to plug in, hit a button, and boom, up come your calls and puts. So, they're both good tools. I just personally like the advanced one, which, I just think is easier to use. a couple other calculators that we offer on the site. And I mentioned earlier our last position on the risk and reward slide was the collar. And the collar is long the underlying, long a downside out of the money put, and short an out of the money call. And so, we've got a tool here where you can go in and create your own collar and then, calculate break-evens and returns and things of that nature. Collars typically are put on when an investor has a profit in the underlying. There typically isn't much money to be made or lost. If you've got a stock at 50 and you decide to initiate a collar at 50, there's generally, typically not much to be gained or lost with that. But if you buy an underlying at 50 and it runs up and you're looking to protect those profits, the collar can be basically, the short call is a potential target for where you would sell the underlying, and that long put is a price where you could get out. And, if you have a profit in an underlying, you could just buy the put, to get out. But when you're buying the put by itself, you're paying X number of dollars. You're basically buying insurance. Oftentimes, the reason for selling the call is really twofold. Maybe number one is that it helps to finance the price of that put. So, you don't pay nearly as much for the insurance. Sometimes you even take in a credit. Sometimes the value of the call is more than the value of the put, depending on the strike prices you pay or, you use. And that's part of the motivation, for selling the call. The other thing is, if you've got a profit and you're selling a call that's higher up out of the money, oftentimes, that's a price point at which an investor would say, hey, I'd be happy to get out of the position at that particular strike. So, we have the collar calculator as well as a covered call calculator. And I haven't mentioned covered calls tonight. The covered call, for those of you who may be just getting started, is thought of as an income generating strategy. The covered call is where the investor is long the underlying and short a call. So that call, I talked about intrinsic value versus at the money or out of the money earlier. We're long the underlying. We can be, short a call, and depending on, what strike price, if it's an out of the money call, it's going to have less money than the value of the at the money call. But when you sell the call, you have the obligation to sell the stock at that strike, plus whatever the premium was. That's the obligation you take on for the benefit of taking in that premium. If you had the underlying and it ran up, you sold a call, and then your forecast changed and you thought the stock was going to go higher, you could buy back the call and sell a higher call. That would be something called rolling. So you could do that. But the covered call calculator basically is going to tell you, you take the underlying and you sell the call. It's going to give you your annualized return for selling that that obligation to deliver the stock at the particular strike. That's what the covered call calculator will do. It'll tell you your return on the strategy. So a lot of investors think of covered calls as another dividend, an extra dividend. The difference there is that if the stock absolutely took off or got taken over at a significantly higher price, you would not reap the benefits of that whole appreciation because you have sold a call at some strike lower than that. So the covered call calculator, again, a dynamite tool. Consider checking it out. Other areas here, we've got when you really have nothing to do, but actually I go in here every once in a while when I'm trying to keep up with different topics in the marketplace. The FAQ, frequently asked questions section, our web services team and the group at Investor Services does a great job keeping that up to date, as well as the option glossary. There you can see it right across the top, A through Z. So a very comprehensive glossary. Again, just different ways you can learn on our site. If we go back to where we started, in the Getting Started Benefits and Risks section, we talked about, very simply, what is an option. Maybe other folks are more interested in just going through the glossary and starting to get acclimated with different strategies and terms in the options business through the glossary itself. Lastly, in terms of the tools and resource section, we've got the options expiration calendar, and it's always the third Friday of the month. Is our expiration on a monthly basis. Of course, we've got a little over 4,200 underlyings. There are stocks, indexes, or ETFs on the 12 exchanges that option products have markets in. Of those about 4,200 underlyings, we've got close to 400 weekly products. So those weeklies have, just like the name, a weekly expiration as well. But something else you can find is the expiration calendar under the tools and resources drop down. So next section, we do have the last thing under tools and resources is the mobile app. So if you are, into, if you're traveling or whatever, and you got your phone, and you want to check out the mobile app, please do so. We've had that up, I think, for about a year and a half now, and it gets quite a bit of action. Under news and resources, we get industry news. We get things, different brochures and literature on the industry. We got a number of white papers posted. We've got research articles and also different market data. These are under not the tools and resources drop-down bar, but actually under news and research. And I think, Nick, I'm not going to put everybody through the explanation of each one of these 18 strategies again, but I post this slide again. Tools are great. Knowledge is even better. But don't forget the end game. And to me, the end game is about enhancing returns, but it is doing it the best way possible from a risk-reward perspective. Again, I made markets on the floor in Philadelphia for better part of 23 years. I watched many, many traders come and go. I saw many, many traders make crazy amounts of money and also lose crazy amounts of money. I gotta tell you, the traders who made crazy amounts of money oftentimes weren't any better than the folks who lost it. Sometimes, those traders, got lucky rather than traded sensibly from a risk-reward standpoint. Oftentimes, they weren't trading with their own capital, but a firm's capital, and took ridiculous risks to get, to basically make money. And I would suggest that oftentimes managers maybe didn't know some of those risks because they weren't paying attention close enough. But you control your own portfolio. I urge you, continue to learn about options and think of options from the risk-reward standpoint. What's my best opportunity to make money while at the same time risking the least amount of capital? And with that, Nick, I think we've got our slide that just mentions our website, as I think folks know, at optionseducation.org. For those who are new, please, we've got our wonderful investor services team They're there 5 days a week for you at 888 options. We've got our mobile app, and thanks to Nick and others at the OIC team, we've got an OIC YouTube channel now that has all kinds of good things. So with that, Nick, I'll turn it over to you.
Joe, thanks so much for all the expertise in taking us through the site today. And we only have a few questions, but before we get to them, I want to remind our listeners to fill out that survey that's on the right side of your screen that I mentioned during the introduction. That information will be very helpful to us as we plan the remaining sessions in our 2015 webinar series. Additionally, if you do have further questions about the tools on the OIC site, as Joe mentioned, you can give Investor Services a call at 888-OPTIONS during normal business hours. They're always ready to help answer questions about option strategies, positions, or the tools you saw on your site today. Joe, a lot of the questions we had actually dealt with the risk versus reward slide. I'm going to go back to that for our listeners today. All the P&L graphs. The first one was, I think, from a new investor, and this person wanted to know what the X and Y axes represent on the P&L charts.
Good question. It's basic break even, Nick. Let's see, vertical axis would be the point of where the stock is currently, and then the horizontal axis represents the break even point. So above the horizontal axis represents a profit, below the horizontal axis represents a loss, and then moving to the right or left of the vertical axis is just the direction of the stock.
Joe, another question we had about these P&L graphs are that some of them actually look the same. Long put spread, short call spread, long call spread, and short put spread. Some of the P&Ls look the same. Can you talk a little bit about what the different strategies entail, even though they have the same P&L?
I will. How about if we pick long call spread, short put spread? Okay. As is the case with maybe almost all option strategies, there's a forecast on the underlying. And a long call spread is where you are long a lower strike call and short a higher strike call. So the forecast is for the underlying to go up. And if we focus on, the P&L chart on the long call spread, that's what's represented here. As the underlying were to move to the right of the vertical axis, we would be making money. We are above the horizontal line. And, we just basically, through these charts, basically represent generalities, but really with regards to the long call spread, being a vertical spread, long the same call, long one strike, short a higher strike, same expiration. Okay, if the difference between those strikes is $5 and we pay $2.50 for that spread, we could make the difference between 2.5 and 5, so we could make 2.5 if the stock goes above the highest strike price, the strike that we're short, and conversely to the downside, we would lose the 2.5 if the stock closed below the long strike of the call that we had, rendering that call worthless at expiration. So the long call spread is a forecast looking for the underlying to go up. Long one call and short a call at a higher strike. Now talking about, a very similar looking chart, let's go to the short put spread. And the difference with and we can see it's the exact same graph. So we're looking for the underlying to go up to make money with this position. Unlike the long call spread where we're long and in the money and short and out of the money call, with the short put spread, we are short the more valuable option and long the less valuable put spread. So let's say the stock's at 50, maybe we're short the 50-45 put spread. If the stock, and let's say we sell that spread for $2. If the stock is at 50, or higher at expiration, we'd have sold the 50 put for 2, or say 2 1/4, bought the 45 put for 25 cents, taking in, the $2 credit. If the stock at expiration is above that 50 strike, we'd have collected that $2 profit. So, that's just, that's how some of these strategies work, and it's frankly why this slide to me is so important and informative, and most importantly, now in the examples that I just talked about, the long call spread and the short put spread, you can see the end of the P&L graphs go horizontal. That means they're limited risk, limited reward strategies. But the long call, the short call, long put, short put, long straddle, short straddle, long strangle, short strangle, what else? Ratio call spread, ratio put spread. I think that's it. They all have potentially, if not unlimited, very significant risk. And that's the key, understanding why those positions have the risk. Again, Nick, the reason for this was to focus on this whole idea of risk-reward. I'm not suggesting that everybody go out and become experts in every option strategy that's out there. Try to focus on just a few, but make sure you know where the end of those P&L graph lines are pointed. Are they pointed up or down? Is there limited risk or unlimited risk? And that will allow you to, continue to build the size of your portfolio and continue to use options long into the future.
Joe, we just hit our 60 minutes for our session, but we did have one last question come in, and again, it's about the P&L charts. This investor wanted to know, do all of the risk and reward strategies that you've discussed here, do they require that the call and put contracts all have the same expiration?
No, they do not. Let's actually, I said no, and Nick, I think I screwed up. I think here in these particulars, they do. Not the same strikes, but they do have the same expirations. That's not, okay, so different strikes in many cases, but the same expiration cycle. As we get into our 2015 webinars, Nick, maybe we will, we will make a commitment to, get into some strategies where, we use different expirations. And I'm sure, over the last year and a half, certainly we've covered some of those strategies, and our investors could find them on our YouTube channel, I'm sure.
Great suggestion, Joe. Do you have any final comments for our listeners today?
No, again, happy to be back on board after, getting through the holidays, and we look forward to a great 2015. And I would just ask those who are still listening, if you like what you hear, tell your friends and have them join us.
Ladies and gentlemen, as I mentioned earlier, today's session will be archived and should be accessible in a few hours using the same link you used to join us today. Additionally, our webinars will be available on the OIC YouTube channel, so you can review a number of option strategies and concepts at your own pace. This one should be available within the next few weeks. As Joe said, thank you very much for your time this afternoon. If we weren't able to get to your questions or you want to know more about the website functionality, as I mentioned, you can call the Investor Services Desk at 888-OPTIONS. Feel free to reach out to them anytime during normal business hours. And we do have one last plug to make for the website. Make sure to check optionseducation.org in the upcoming weeks for our upcoming 2015 sessions. We've got 2 more in the books, one in February and one in early March, so please attend those and mark your calendars today. Ladies and gentlemen, thank you again for attending, and we hope to see you again next time.